Hey everyone, this episode is brought to you by Kinto, the safety-first L2 accelerating the transition to an on-chain financial system. You're going to be hearing all about them later in the episode, but for now, on with the program. All right, everyone, welcome back to another episode of On the Margin. You got Felix, Quinn, Tyler. Fellas, it's good to be back. It's good to be back. How are we all doing?
Mike, you look refreshed. Look at you with a
I did, thank you.
Big blue
Yeah, you could call it
eye.
Mediterranean God sort of vibe here that I'm rocking. Yeah, totally, 100%.
Without the muscles.
Way without the muscles, yeah. Went on a boat, took the old shirt off, was like, oh yeah, okay. It's been a long winter in New York. But yeah, it's good to be back. I missed you guys. This was one of those weeks where I feel like I came back and missed like a whole year's worth of news also. Bunch of stuff.
But the market barely moved from a week ago. That's the funny part.
I know.
Yeah. I mean, it's hard to keep up with. I was at my computer all week and I still feel like I missed everything. There's just so much going on.
There's a lot. Maybe we could do a little bit of a recap of, this was a big weekend. It was like I did an interview with Bob Elliott this week, called it the policy Super Bowl. So we had the FOMC and the QRA this week, and that's already been talked about quite a bit. And I'm sure folks who are listening to this podcast probably, you could either catch the Bob Elliott interview, or I'm sure you've probably been hearing about it on your feeds. But I thought we could just do a quick recap there. So the FOMC in general was largely interpreted as pretty dovish. Obviously, there's no rate hikes, no rate cuts. What we did end up getting was, Powell talked about, I think a lot of the emphasis was on QT there as well, which sends like a slightly bullish signal to the market. But, in general, I think the Felix, you did a really good job of calling out, like, going into this presser, there's a reversal from the beginning of the year where the market was pricing many more rate cuts than what the Fed was saying, but actually going into this presser, it had been reversed, and the market was much more bearish than what the Fed was actually saying. So whoever wants to take it, like any big takeaways from either the FOMC or the QRA from your guys' standpoint?
On the QRA side, I was digging in a little bit into some of the issuance forecasts, and overall, there's a few people that were expecting us to see, it really depends on where you sit on the spectrum of, maybe you call it political deceit leading up into election. That really drives a lot of people's opinions of what they might expect out of the QRA. So there's, on one side of that spectrum, people that were saying, all right, Janet Yellen's going to, start to indicate that she's going to run down the TGA account to $0 and pump the markets into the election. And then there's the other side of the equation that says, no, it's pretty set well in stone that, the TGA needs to stay at 750 billion. And so a lot of your perspective on that drives a lot of what your analysis of the QRA. But overall, speaking of the pure number terms, what we saw is that overall, the dollar value was higher than expected in terms of outright debt issuance. But at the same time, the composition, which is the other side of the equation, in terms of coupon debt profiles, that didn't change. So there was no net new duration surprises in terms of anything from 5-year and higher. So that the take up is going to be in bill issuance. The second component of that as well is in the Q3, the guidance around the TGA account. That's looking to go up from 750 billion to 850 billion. Looking right now at the TGA account, we're at about 950 billion. So that's obviously almost 200 above the 750 target, 100 over the 850 target. But we're seeing some negative bill issuance coming this quarter. So that's going to net out and basically not really much happen. So overall, there was slight hints of hawkishness, slight hints of dovishness, but really it's very little impact on that side of things.
Yeah, for me, the biggest takeaways were looking at the context and clues around, obviously, the quantitative releases. So you had a QRA where debt issuance came in higher. That's net, hawkish or bad for liquidity. On the bright side, it's funded with an increase in bills and a maintaining of the status quo on coupons, which should tap into the RRP. But a couple of things that I noted in that release were, in the report, they talked about the potential revisiting of their 15 to 20% bills issuance. And if I have that right, it's the 15-20% recommend T-bill range. And they said revisit that in the future, which is saying like, they might deter that, which is like a softening of liquidity stance. And then the other one is they're highlighting of the Treasury buyback system to improve the functioning of the T-bills. And then you go to the Fed, and that was just more blatantly dovish. And I viewed the the announcement of the QT rollback, consensus was 30 in June, and we got a month sooner. It starts in June, but they announced, people expect them to announce next month, and they did 25 down to 25 instead of down to 30, which is an extra $5 billion a month. Kind of like a little, someone on Twitter called it a little kiss from Powell to reassure liquidity. And so you pair these together, and then, an hour or two after that FOMC wraps, you get the second yen intervention just after a week of policy meetings with these global leaders. And you put everything together and you're like, that plus Powell's stress on their potential to cut rates if jobs weaken. And then we get today's soft jobs report. All these clues just show, all right, they see the problem clear as day. The market, they're not stupid. The market is calling out these liquidity crunches and the higher bond yields, but they're well aware, and they're doing, they can't not fund the government deficits, but they're going to do it, and they're going to do it in a way that, and try and tweak things around the edges to support liquidity. And to me, that's the most important thing that caused me to flip bullish is, we've had this huge pricing in of higher for longer and the inflation trade. You've gotten oil rolling. They're trying to roll the dollar. Yields are rolling. It seems to me that, with these strong earnings in Q1, there's no reason why we won't be back to all-time highs in the next few months.
To that point, I wanted to do a little talk in the mirror here, which is Mike's favorite topic of, what we got right and what we got wrong. And basically, I think if you step back, we got more right than wrong. Like Felix said during the Israel stuff, you got to fade the volatility move. We saw the VIX get inverted. Basically, everyone was buying protection, right? As the VIX goes up, there's like this self-reinforcing things from these CTA and risk parity funds, and they bid up volatility in the equity market just to insane levels. So now that everything is copacetic and the vol controllers, the policymakers have kind of like calmed things down a bit and there's more clarity. Now the event risk is gone and the volatility falls. So Felix kind of nailed that one. In terms of the yen, I think we were saying, they have to step in here. You can't have a multiple $1 trillion carry trade unwind. The Japanese are our largest buyer of foreign debt on the treasury side and corporate bonds. And so like, I got to give myself credit there where it's like, you have to defend the yen. Otherwise this giant carry trade unwinds and it really causes more effects in the corporate bond market. We're seeing that. And I think that if we hit these levels again, they'll probably do it. But right now that seems copacetic as well. So volatility across all assets has kind of gone down. So here's the interesting thing. And if you step back from a 20,000 foot view, we're looking at, this is high yield CDS. So the lower this goes, the more credit spreads come in and the bond market does better. So largely for the past couple of years, the credit market's been great. That short blip up above 350 was the Israel kind of like the Israel thing. And now we're going back below the 50-day moving average means the credit market is fine. So from a 20,000 foot view, the corporate bond market is actually doing quite well. This problem was largely on the backs of, the sovereign issue, which is we live in a more globalized world, more centrally planned world. So when you get to these extremes on the sovereign side of things, policymakers have to step in and vol control. And I think, Felix kind of nailed that one. Quinn got the backdrop right too, in terms of he was bearish or moderately stepped to the side on all this volatility. And now he's coming back in bullish. So that's one thing I got wrong personally. I thought Bitcoin would read through this and kind of do more like what gold did, which is like rally into fear. And it's clearly not that type of asset just yet. So, we'll see what happens here in the next couple of weeks, but that's where I'm at.
I'll give one last thing is a little kiss for listeners like Powell did with the 25. I wrote this big tweet thread and talked about, what happens if oil rolls, dollar rolls, liquidity's buffered. You have the yen, yen weakening, yen strengthening, dollar weakening. A weak NFP would turbocharge that. We got that. And just this little thing that I didn't put in there was the comps for April CPI in 2023. We had February and March, easy comps, high inflation. The comp for April CPI, which we get on, I think the 15th, is actually a very, very difficult one or high. So in my opinion, we're likely to fall in below, and meaning, risk on. And that would be kind of the final send, I think, to catapult us back into the bull market structure.
Hey everyone, this episode is brought to you by Kinto, the safety first layer 2 that is accelerating the transition to the on-chain financial system. Now, I know we're all very excited about tokenization. Larry Fink certainly is. He's on CNBC talking about it all the time. And I know we're all very excited about L2s. Here's the problem though. If we want L2s to onboard the financial system, there's a lot of stuff that we still need. And Kinto is basically rolling out solutions for that. So one, it features user-owned KYC, which is just table stakes for our regulated friends. And if we want the institutional capital to come in, Kinto offers a really good solution for that. They also have native account abstraction that solves some of the largest problems with onboarding in terms of security and user experience today, which is still very confusing. So if we want to bring more folks onto Ethereum, Kinto is the way to do that. And if you believe in this on-chain financial system and you actually want to get more active in Kinto and become a founding member, you should join their launch program, which is Engine. That's ENGN. You can see a link in the show notes. So if you're a part of that, you can do things like participate in Kinto governance, the launch ceremony, you can priority access to product launches on Kinto, you get reduced fees and unique discounts on products launched on Kinto. So overall, if you want to be a part of Kinto and the mission that they have, I would go click the link, join the Engine program, and thank me later.
Could you be a little more Quinn specific on like the timing there when you say catapult us back into a bull? Is this like through end of 2024? Or what's the relative time frame here on this like sort of bullish wave that we've got?
Yeah, it's through election basically, like give or take a month or two. You're just not going to see a stance change, a bigger picture. You're going to get these pullbacks of these when there's these liquidity pockets, but every time since we've seen for the last how many months, the policymakers will come in with their coordinated action, and that lasts at least through the election. I think the flexibility and their ability to support markets and ignore inflation kind of stops probably towards the end of this year, and so it lines up with the election in that sense as well. So yeah, I think through that time period, you're a dip buyer.
You know what really frustrates me about a lot of this stuff is the market structure is so messed up because there's the price insensitive buyers and sellers. Like as volatility rises, you get this like quantitative bid to volatility, and you get a delevering in equities, and then it gets overdone. And now we're just like skyrocketing back as these CTAs and risk parity funds like lever back up with the VIX falling. And to me, like that is just, it's communism. Like you're not investing. Like when you step back and think about this, you're not investing in a founder of a company to do a good thing for growth of the economy. You're literally you're reacting to price. Your models are reacting to price, and it subverts what investment and growth should be. And so like at some point when our generation takes over and realizes like this is undermining US growth in general, it's like what it's playing is not to lose, but that's not the point of investment. The point of investment is to grow things. And to me, it's just like, it's such a ridiculous thing that like we get to these points and then all of a sudden, protection rolls off. I see everyone buying VIX calls, everyone buying S&P downside puts, and then it rolls off and then the game just starts over. And now Apple's doing a $110 billion buyback, stifling volatility. And then money goes back into the risk parity funds and they lever up. It's like the whole premise of investing is just upside down. And it drives me nuts because like we take advantage of it and hopefully more and more active managers will take advantage of it. But it's so perverted. It's crazy. Rant over.
Yeah. I think that's really important is that it's really hard to find signal in the market now because you have all of that occurring. And there's the other side, which is something I've talked a bit about, is I'm really concerned with how valid the risk-free rate is. And the risk-free rate is the foundation of all valuation in markets. I started originally as a pretty ardent like value investor style, Buffett fan and all of that. And when I would go through these valuations and read more about macro, I would get to this realization that, okay, well, if my discount rate is, being warped or manipulated by, the effects of price insensitive buyers and sellers, such as the Federal Reserve with quantitative easing, it's really hard to derive signal in terms of what an actual discount rate should be. So if I can't even get the discount rate right, how can I get any other valuation right? So that was my personal journey to go from this traditional value investor style approach to where I'm at now, which is a pretty, strong proponent of Bitcoin, because I feel like that's one of the last markets with true signal. And it really goes, when you have the quantitative side that you're talking about, Tyler, and the discount rate that's hard to really have like a true signal on. Where do you even stand anymore?
Yeah. You know what my favorite meme of the week was? When Tesla, had crappy earnings and some guy showed a Benjamin Graham book throwing it in the trash. Did you guys see that one?
Yeah.
The intelligent investor, like this doesn't work anymore. It's all about
Stock pops
flows and
30%. Yeah, stock's up huge on the week, and it's a
like that's got to unwind at some point. I got to imagine like over time, as inflation and the movement from capital to labor happens, it'll naturally reset all these like weird incentives. But I mean, my bigger rant is like why this exists is because you cut the cost of access to the market. Like high frequency trading brought in spreads. Spreads allowed ETFs to proliferate. ETFs allowed quant funds and all these other funds to proliferate. And it all happened because the barrier to access dropped. It's similar to like media, how like you used to have news stations and there was a barrier to access. And now the barrier to access is zero and so you have all these morons like us talking on podcasts. And now you have to find the information, right? Everything gets commoditized and there's really perverse effects. So now you have to find where the real price signals are and the real value is, but it gets perverted in all the extra stuff. So
are you advocating for gatekeepers, Tyler,
I'm
or what are
advocating
you-
that you start charging.
It's not very for the common man of you.
You got to charge a hurdle rate for investment. You have to charge a hurdle rate for information if it's good, and that's sort of the problem here is like this is run amok. And what happens when you cut spreads to zero is you want eyeballs, right? And you want high frequency trading, which perverts the fact of investment, of long-term investment, which is why like private investing actually makes a lot more sense from a long-term perspective. And what happens also with ETFs is like you can cut a lot of labor because the access is so easy. The due diligence you do on stocks doesn't exist anymore. So it just like you push things in and then push things out, and it's really bizarre. And I think that will adjust.
So let me respond to this in terms of media, because I've thought about this an enormous amount. So I basically think that the overall trend that you're describing here is the failure of institutions. And like, let's take media as an institution here. This is how media used to get set up. Media had two different value propositions. They had access to people. So they had like the pipes if you wanted to reach a bunch of people. And then they had this sort of fuzzy, if we say this, it's true type. And those two things were linked. And now what media has, the pros, by the way, of that is that there's a really consistent like understanding of what the truth was. You had Walter Cronkite, and that's the way it was. And everyone just believed this one guy, right? And that's actually really nice. That's a comforting view of the world because everyone believes the same thing. The obvious downside to that is that that's a centralization risk, right? And these people could be wrong and they could develop weird biases, which, by the way, is kind of what happened. And then usually when this like latent issue with the way that an institution is set up, biases in media, confronts a new technology that allows you to go around that, it breaks it. And that's just what's happening right now. And these people that are saying citizen journalism, I'm sorry, that's so stupid. Like, how about citizen police officers, like citizen lawyers? Like that makes no sense. Like journalism is, you could have a problem with it, but it's a profession, just like anything else. And so the people that are clinging to how media works today are wrong because it's going to get disrupted. And the people that are saying we don't need any institutions, just go right to the people, those people are wrong too. I think what's going to happen is that social media is just going to continue to break media. And then what's going to happen is like something new is going to end up forming that was like kind of similar to what used to exist with minor differences.
Block works.
Exactly.
The unbundling and bundling. I think it's Galloway that talks about that. At first you have to unbundle it, and then it makes sense to rebundle it back up.
You know what another example of that would be is Netflix. So remember when Netflix was getting started and all these traditional cable companies were like, guys, here's what's going to happen. Like Netflix has to monetize eventually. They're going to have ads. You can't have 10, 20 different streaming services. And now what's happened, like that's happening. Netflix is going to have ads. There are many different streaming services. They're going to start to combine and rebundle. But who was ultimately right? Because those cable companies got fucked in the meantime. So everyone gets to be right and wrong at the same time. And Tyler, probably like just to give a little bit of pushback to the passive thing, like the gatekeepers that used to exist were active managers. And, you know, a lot of the active managers underperformed for such a long period of time that like this new thing ended up happening, right? Which is lowering the barrier to entry for markets for everyone. And it has its own massive problems, but it's broken active management. Now it's breaking itself. I don't know what the solution is ultimately going to end up being. Maybe like swing in the other direction, but I don't know. I think there is another side to this, right? Where like the actives did underperform for a really long time, and that's why and overcharged. So that's why people wanted the passive.
But here, did they outperform because they were undercut on price, and it was the assets were pushed there because it was cheaper? And then this is interesting because the same argument can be made about globalization. Was it good, like the Sir James Naismith or Goldsmith? Not Naismith, he's a basketball guy. He like when you cut, your costs of employment, there's side effects, right? And it's the same thing where like you allowed China to grow, but did that really disincentivize America in a lot of senses? So like I'd argue like the net negative of passive management is bigger than, paying higher fees for active management, even though they're underperforming. Now you might see like inevitably active management should outperform here. And then that money comes flowing back and you have kind of like pricing power, I guess.
The second active management outperforms for like a 3-year stretch, all the passive ETFs will have competition. That's just a fact. And I think it goes to Felix, your point about when you're manipulating the supply of money, so every asset indiscriminately goes up. You don't need active management, and we're seeing a structural. It's going to be it's not a 1-year trend; it's a 10, 15, 20-year trend reversal of the actual repricing of money and capital, and that's ultimately good for really, really positive for active. And I think that's really what it boils down to is how I'm a believer. I've gone on Twitter rants about this before, that almost every problem in like our society can be boiled down to the distortion of money, the cost of money. Because even you look at the things going on in college campuses, there's no world where you could take out a $200,000, $300,000 loan with $50K annual earnings power on the other side and get approved for that line of credit. But it's happening and pushing up the cost of tuition, faster than any other, inflationary price in the country. So there's all these things that boil down, and the talking heads in government, it makes sense why they don't acknowledge it, that because they don't want you to believe it. It would damn their credibility and their institutions. And so it ties in all of that, the loss of trust and credibility of institutions.
Can we bring up on that point, we should probably bring up that Jared Bernstein clip. I don't know if we can play this or not.
Yeah.
But
I missed this.
Guy,
it's incredible. Biden's economic policy advisor, that he doesn't know how the government funds itself. He's like, we issue bonds and then we print money. Wait, those bonds. Yeah. The bonds? It's cash. Wait,
and the best part is that he's being interviewed by Stephanie Kelton, which, there's some irony in that one as well.
Oh, man. Yeah.
And look at this. Look at his resume. He's a senior fellow at the Center of Budget and Policy Priorities. From 2009 to 2011, Bernstein was the chief economist and economic advisor to Vice President Joe Biden, the Obama administration. So like these guys are all false prophets. What's fascinating to me is your average crypto person understands the monetary system. The next generation gets it. And it's like this weird dynamic of like, I know why you're successful, because like you are a bureaucrat in like a massively growing system, and like you don't even know why you were successful. It's kind of like in sports when a guy hits a game-winning shot and he really sucks, and you're like, yeah, but like you suck. Like you hit the game-winning shot, but like you've no idea how you did it. And it's like
he was Biden's ice cream scooper. That's why he got the promo.
It just drives me nuts that we see this.
You got to give a shout out to, I've been reading Skin in the Game from Nassim Taleb again, and I think there's still a lot of lessons to grab from that one. Is that here's a guy who's no skin in the game, versus these crypto guys. They got a lot of skin in the game. They got over 100% of their net worth skin in the game. So they're on they're on
300% of their skin in the game.
You better know how debt gets issued if you got 100x leverage perps. So it forces you to learn some things out there.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Crypto is, first of all, in many ways, it's rebuilding a financial system from scratch. And so it makes you think about first principles. But I've always thought that crypto is just a little, like, one shade more honest than people in finance are. Like, that's what, like, embracing this term. I'm not a fan, by the way, of embracing the term Ponzi and stuff like that. But, it sounds very conspiratorial to say that the way the U.S. government funds itself right now is like Ponzi-like, right? Like, borrowing new money to pay off old money is relatively Ponzi-like. And as soon as you get down into like the structure of how a lot of these different financial products work, crypto took it all from somewhere, right? We're not inventing new shit, actually, for the most part.
You ever read that book, Lords of Finance by Liakata Ahmed? It's like, to a T, history rewriting itself. All the same things happening over and over. And it's inevitable, I guess, once you get in those positions of institutions. It's like your incentive is to lie when they grow that big.
Bringing it back to a point I talked about this week, but some people were asking the biggest Ponzi of them all, which is Japan. I had a lot of people asking, like, this seems like a big deal. Why does it matter? Is it Japan's problem? How is it our problem? How does it affect global liquidity? And the context I gave is Japan is paying 25% of their country's annual budget to service their debt and pay interest on their outstanding debt. Meanwhile, their interest rate, that cost of the debt, percentage-wise, is between 0 and 2%. Their 10-year is less than 1%, and their 30-year is less than 2%, and their short-term rate is 0.1%. So, quote unquote, call it zero interest rates, and it still costs them 25% of their annual budget. In the US, that number is about 15% of our annual budget for debt service, and we're paying 5%. So imagine, that's the problem here is Japan's bond market yields are going up. They're saying you're losing credibility because your monetary policy is too loose. And the officials are saying, well, we can't tighten monetary policy and pay higher interest rates because say we increase interest rates from 0 to 2% to 1 to 3 or 2 to 4. Now all of a sudden you're paying 50 to 75% of your annual budget to pay interest expense. And how do you do that? You issue more debt. It makes your bond yield sell off more and go up. So that is a true definition of Ponzi. And the thing is it becomes the US's it's very siloed to Japan than any other country, but it becomes the US's problem when the largest bond, US sovereign debt holder, Japan, has to support their currency, sell US treasuries, liquidity tightens, and then it's a problem at home and that's why you're seeing the people who can temporarily fix this, it's not long-term fixes, are Yellen and Powell being dovish, adding liquidity. And, that's why you're seeing this clearly coordinated action, when oil's coming off, when yields are coming down, dovish policy gives Japan the light to intervene, strengthen their currency to weaken the dollar. And all it does is it makes people want less of these manipulated assets and more of a neutral store of value, which gold and Bitcoin, we're seeing strength and it's a self-perpetuating thing. So I think there's a lot for people interested in why that matters to Bitcoin and gold and broader asset markets, a lot of conceptual learning if you want to go down a rabbit hole.
Yeah, I just wanted to share this chart of the Minsky cycle, which I think is a really useful conceptual framework of this, is that basically what it shows is just what happens when credit gets so far ahead that you have to issue credit to refinance the old credit and keep doing so. And as that accelerates in an economy and in a market, you reach this point where it's this self-fulfilling cycle of issuing debt just to simply keep treading water on the previously issued debt. And as that accelerates, you eventually hit this moment where it just all collapses on itself. So I think a lot of what you're talking about is, you could argue Japan's a bit closer into that Ponzi borrowing phase where they have to basically outright own the entire bond market just to stay afloat, versus the US is a little, you could argue they're more so in that speculative phase. But, this is an interesting thought experiment, I think, of what can tangibly occur during this. Is that you can continue to get to this refinancing cycle, like Michael Howell talks a lot about at cross-border capital, is you go through this refinancing cycle and you have to keep doing that. And now we're doing it at higher rates. And that just creates this nonlinear effect up until the point where, it all collapses on itself. And then, then you can get into the, we need a debt jubilee or something like that. But to me, this is in this simple chart is that saying, okay, the US isn't speculative going towards Ponzi. I need to own hard assets and I don't want to be owning bonds.
Felix, I'm glad you brought that up because you actually sent this to me. So you put me on this. Bill Gross wrote this article this week, and he calls out Vanguard's total bond index, and it's provided a negative 0.1 total return over the last 5 years. And they're not even taking into account inflation there. So you're negative net losing money. And every boomer probably owns this thing. And then at the bottom of this article that he writes, he goes, it's a Sisyphean decline in bonds. Total return is dead. Don't let them sell you a bond fund. And this guy, whatever you think of Bill Gross, I mean, he's a polarizing figure, but he was known as the king of bonds for like years and years and years. And he's telling you to don't buy bonds. Like, that's kind of crazy. When you think about that whole thing, that he saw the evolution of when, in the 80s, when you bought any bond, it just went up because inflation was dropping and globalization was growing. And now the whole reverse is happening, yet the policymakers will have to do yield curve control. We all know this. It's like, how much pain can you take and how much political jawboning can you do before they call BS on it? And I don't know.
He also references this, what they used to call bonds back in the day, which is certificates of confiscation, which is so funny because at the end of that inflation cycle, people just got so used to losing money because of what the Fed was doing to interest rates that it was just like, don't be that suck. Like, don't buy a bond. It's just, I know the interest rate looks high, but you're still going to lose money. And he talks about having to invent this term, total return, so that they could actually hawk more bond funds, and now we all just accept that as gospel.
I mean, do you need any more proof from a guy that made billions and he's extremely wealthy and every dime he made was from bonds and he's totally renouncing, them as an asset? Like, I mean, obviously do your own research, but you don't need a better signal and point than that.
The one thing I'll say, though, is that he's now selling a subscription for $9.99.
Yeah, I did see that.
Because he bought too many bonds and he's poor.
Boy.
Dude, come on with that.
You know what? Someone actually mentioned this when Ray Dalio put out Principles and he started doing those YouTube videos 4 or 5 years ago. I was like, man, these are great. And someone I met with this guy from 2 Sigma. And I was like, hey, the Ray Dalio stuff's pretty good. He's like, oh, dude. It's like, there's no better tell that a hedge fund manager's lost it than they start to create content. And I was like, and I was like, oh, okay. I hadn't really thought about that. And now you've got, I don't know if any of you guys have read The Firm, but that's pretty damning idea.
That holds for the crypto hedge fund that I see making the most content as well. I think names won't be named.
Yeah. Although I got to be honest, there is a massive return for new up and coming managers to do some media. Like when I was at, Real Vision, Blockworks, you can see guys like Harris Kupperman, was not.
He's so good. I love him.
I mean, he's so good. He's so good, and
he could be a comedian if he ever.
Oh yeah.
He's so good.
Yeah, can you pull up the to your point on bonds? pull up slide number 15.
Yeah, I got you.
Cuppy's tweet when the Israel and Iran stuff was popping off, and he sends
DM'd.
he DM'd the Iran's leader and said, "What should I do with oil here? Is it a bid?" And he's like, posted Twitter saying he's like, "I'll let you guys know what he says."
So I got to bring up this chart on the back of the bond thing. So right now there's, what is it, 1.4 trillion in money market funds, and your bond funds are rolling over while equity funds are getting, inflows. We could be seeing the beginnings, and this is just a thought experiment, but if policymakers are really behind this liquidity cycle, you could see money come out of money markets and go rifling into equities and bonds similarly. Like this could be what they talked about is the great rotation. Like we could see that in Weimar Germany. The only way to protect your price, your value of thing was to buy equities. And for a generation, no one bought bonds there because you just, certificates of confiscation. And so look at this chart. Every time money market funds, jack up to plus, 1.5 trillion, equities are down, right? It's almost a bubble in cash or money market funds, right? And then that money market funds roll down and money goes back into equities. Except you're doing this at a time where the big tech companies are actually buying back $1 trillion of stock. So it's an incredibly shrinking equity market with a lot of cash. Like the floats are shrinking even in this world. It's kind of nuts to think about, right?
That's why you're not going to get and we've talked about this concept too, and it's an important one to just drill into your mind, is when you get bearish on risk or anything, you just know, the doom and gloomers calling for an 0809 style credit crunch it's not going to come to fruition, because for this reason, among others, this is a byproduct of fiscal dominance and the Treasury funding all of that fiscal dominance and deficit spending with bills issuance and not bond issuance is this glut. So when rates ultimately do come down on the front end and all this money market earning 5%, family offices, high net worths are loving all the yield there with no lockup, then that needs another home. And then that's when you get that next wave of commodity inflation and real asset inflation and, going into other assets. So I think there's so many of these interlinkings here that are going to, be very important in the years to come.
The one thing about this chart is I do understand the premise of the rotation into it, but I've heard some people characterize this as, oh my god, look at all this sideline cash outside of the market. But true, that's true. But also, if these money market funds, somebody has to be on the other side of that trade and be buying it, and so what are they selling to finance that, right? So we've seen the net new increase in the past 2 years from the fiscal issuance, and that's created that net new money. But I'd be curious on your guys' thoughts. Like, how much do these rotations actually change liquidity versus it's just the change of like a journal entry, like who's on the other side of this trade and what are they selling?
That's a great question.
That's a great question.
I think
I don't know the answer either. So
Mike Green, I think, talks a lot about this, which is, people talking about cash on the sidelines as being like one of the dumbest things you can say, because for every trade, there's a buyer and a seller. And it's like, I think it goes to kind of what we talk about a little bit in crypto and other things where we talk about these supply events, but it's really the demand. And I think that's a broader point here is like, yes, there's, relative allocation over under allocation to this asset class or that asset class. But at the end of the day, price in the market is based on, yes, somewhat supply, but also demand. And you can have big changes in price because demand shifts up or down in big ways without like quote unquote supply changing. It's just where people want to transact at. So I think it's good to stay balanced.
I think the cash on the sidelines thing, more anecdotal from a crypto perspective, but anytime someone says there's a ton of dry powder on the sidelines, I always get a little bit bearish because people love to say that when it's down and they're like, well, look at how much money is on the sidelines still going to invest. And it's like pretty strong contraindication.
The other really, really just doesn't make any sense argument is when people say, oh my God, airdrop season coming on pick your chain on Solana or whatever, and it's going to be this huge stimulus event. Well, not actually, because what happens when there's an airdrop? Yeah, it's at this paper inflated value, but if I'm selling my airdrop for this liquidity event, someone's buying it with something else, and it's actually, if anything, a liquidity suck and not this big stimulus. So that's another contra argument where you're like, all right, fade.
Can you explain airdrops to me? This is going to sound like, I think I just missed this boat by like a little bit.
It's basically if
giving you free money. Like I just don't. It's giving you money for free.
The idea behind it is if you're like the analog would be if you're a Web2
How this 40-year-old
startup.
brain is just really struggling with this. It's like it does not compute the free money, and
you have to go to Colombia to get it, Tyler. You wouldn't understand.
Is it like you're unlocking part of the float to be more tradable or something?
Wait, here, can I actually give you like there actually is a logical descriptor of what this is, and there was at one point a lot more logic that came along with it, and people sort of lost the plot. All right, part of the original impetus behind airdrops and like yield farming writ large was an erroneous belief that you needed to distribute your token as far and wide as you possibly could into as many hands as possible to decentralize governance. Like that actually was an enormous driver of initial airdrops and emissions, to the extreme where some protocols like Sushi or Yearn actually dropped their entire token supply and was like, hey, community, govern us. That was really bad.
To me, that sounds like the Confederate dollar, where they just like spread that thing around, devalued the hell out of it, and
look at how Yearn and Sushi are doing.
Look at how Yearn and Sushi are doing. The other thing that actually makes some amount of sense is you are acquiring customers by giving equity in your protocol instead of dollars. So think about what PayPal used to do. It's like, hey, you get $20 every single time you refer to someone to PayPal. This is like their famous viral marketing campaign. But instead of handing out dollars that you raise from VCs, you're issuing equity from the company and just distributing that to users in the hopes that they go onto the platform and become a user. And that actually makes like some amount of sense.
Mathematical sense. I get that. Yeah. It's like kind of like they used to have this delivery thing in San Francisco for food. I forget the name of it now, where they give $10 referral for every person you did. So they're net losing, but net growing.
I think one way to look at it too is just the addition of net market cap to total market cap of crypto when an airdrop occurs. And how that works is that, okay, if you create a paper gain of some protocol that's at $1 billion market cap, and the initial pool that launches with that airdrop has $1 million in liquidity or something in it. So you have a lot of paper gains on there, but really the door to exit is very small because there's a $1 million pool with funds in there that are maybe from initial investors or venture capital that sets up the airdrop. And those venture capital firms, if they get a certain percentage of their tokens on TGE, they can sell into that pool too. So it's basically just a levering up in a way, and creating some liquid paper wealth that really in action is you have a $1 million pool for a $1 billion protocol. So if everybody sold at once, that would look very differently.
So here's a sort of a perverse thing that's happened, that the dynamics in crypto of these like low float, high FDV tokens, like very predatory type things, actually like in some ways you could blame that on regulation. So remember ICOs in 2017 and 2018, and you probably have some memory of those just being like ridiculously scammy, hypey things. Well, what those was a project was selling tokens. We all called them utility tokens back then, to investors, and they would literally just structure it like an IPO, except it's not a securities because it's a utility token, and they would just sell a bunch of it to new investors. And I can't really remember what the supplies could, but they would sell like 70% or something like that of the token supply, and some amount would be reserved for the team. And then regulators came in. There were a bunch of enforcement actions, and projects were like, okay, I get it. We can't sell to the public because that's too risky. So instead, we're going to but we still want retail and like the community to have some amount of tokens. And so we're going to do these airdrops where we give them away. But if you're giving them away and not selling them, you're not going to give 70% of your token supply away. That's ridiculous. So you give away a much smaller percent, right? And then when the token goes live, it's instead of trading on 70% float. It's trading on 5%.
That makes a lot of sense. Yeah.
Do you know, like, and so that dynamic is fucking people. And the reason why, like, one of the reasons why meme coins have a bid right now is they fair launch, and they just 100% of the existing tokens are available on day one. And then retail's like, you know what? At least I'm not going to get dumped on by VCs.
Mm-hmm. Gotcha.
And there's still the upside available because you can buy some of these at $1 million market cap, and most of them go to zero, but at least they're not launching at like $13 billion FTV or something.
Did you guys see this Martin Shkreli drama on Twitter this weekend? Oh my God. Honestly,
Legendary.
God,
I don't know
God help
anything
us.
about it, but we need more people calling BS on this industry.
I think this guy's having a redemption arc, and honestly, I was a hater for a long time, but I'm willing to be proven wrong. So there's a very new hyped project called IONet, and it's a decentralized AI. The idea is that it's like Airbnb for GPUs. So if you have like a task that requires some computational AI, those decentralized marketplace is going to connect you to these types of things. So Martin Shkreli goes on. The IONet is a very hyped one, and Martin Shkreli goes on is like actually just tries to use it, can't use it. Finds out that a bunch of these things are bots. Like there are way fewer GPUs on the network than was advertised. And he just like hammers them. Is like, this is bullshit. I can't even do one task. And eventually people are like, all right, good on you, Martin Shkreli. Like, didn't think, so anyway.
You know what I think about when Martin Shkreli was on like a podcast with SBF right after he got out of jail?
Oh my God.
And he was
Yeah,
like, don't worry, you're just going to go to jail for like a couple of years. And then
It's not that bad, he said, or something.
Oh, and he got like, the guy tells the truth in a lot of senses, and he does pretty brilliant. Maybe you're right about the
best part about that is it was like I actually know a couple of investors who were diligencing that business and passed, pre all this stuff, and now the classic they look smart, but it was always pretty scammy, and you could never use the product. They had these nice videos and demos, but then they were videos and you couldn't actually use it. So we need more of that, and good on Martin Shkreli for kind of storming through the mud to get that out. But the crazy thing is they were next on the list for one of these huge high FTV low float token launches that was going to be a couple billion. There's some very prominent VC backers, and turns out it's this big like smoke and mirrors thing. And so
it happens in real life too. Do you guys remember when Nikola just rolled their truck down the hill?
Oh, amazing.
And
the SPAC era was just beautiful.
Yeah, that was bad.
I got to bring this up because this is kind of fascinating. And this is not investment advice, or I'm not invested in any of these, but Nikola still has an $860 million market cap. And there's companies out there that are like actually producing money. They're profitable. And this thing is just like a walking zombie still. I mean, it's really incredible what you can do when people give you money for a while. You can kick off like you're just walking.
That's the story of 90% of crypto tokens. They launch it and they like don't go to zero because who's going to short it when it's illiquid and you could get blown up?
The cash value or something. I don't know.
It's not even the cash value. I think it's what Quinn just said. It's like if it's super illiquid and if you're short it, like just any amount of inflows could just rip your face off and get blown out. Like,
yeah, they put out one scam announcement. It's like, there's the classic crypto, there's a big $1 billion unlock coming up, and we announced some fake headline and get people off sides again.
Do you guys want to just talk about Coinbase earnings really quick? That was here, let me share my screen here because there was a big beat for Coinbase. And Coinbase, I always love to just actually listen in on earnings call for this because we've got one reputable public company in the entire industry. So Coinbase basically puts the weight of the industry on their back. But it was a massive beat for them. Like they had, if you're following along via video here, you can see revenue grew from 900 million last quarter to 1.5 or just under 1.6 billion this quarter. The real story is on the adjusted EBITDA. So if you listen to Coinbase, they used to have this goal of they wanted to make money in bull markets and minimize losses in bear markets. They switched a couple quarters ago. Now the strategic imperative is to generate positive adjusted EBITDA in all market conditions. They're trying to make their business less cyclical. They generated over $1 billion of EBITDA on their 1.5 or 1.6 of top line. So that's almost a 60%, again, adjusted EBITDA margin, but still extremely positive. And yeah, there's a bunch of, you could look at this. There's a bunch. They break out their revenue by transaction revenue. There's a new line item here, by the way. So they break it out consumer and institutional, but this other transaction revenue is mostly base sequencer fees. So this is also other payment stuff, which is like whatever people spend on debit card and Coinbase Commerce and stuff like that. But it's super marginal. Like this is mostly base sequencer fees. So it's cool that they're breaking this out. This used to just be lumped in with consumer. And then this is their, what they would call their what's the opposite of pro-cyclical, or contra-cyclical, whatever, revenue basket, which is stablecoin revenue, which is the interest that they get from their partnership with Circle and USDC. Blockchain Rewards is their staking business, although this is still extremely pro-cyclical. You can see this jump from 95 to 150 million. That's all just ETH price appreciation for the most part. And then like a bunch of other little stuff like custodial fee. I'm assuming this jump is from the ETFs, but yeah, it was a nice little beat for Coinbase. I don't know if you guys had any other takeaways or thoughts.
Mike, you're putting on your little consultant hat there. I'm pretty impressed.
I am putting on my ex consultant hat here. Yeah.
Mike wears every hat.
That's yeah.
I saw some the latest the Bell Curve podcast. I read like the recap. Someone did a tweet thread. I think it's Felipe at there, and I didn't even know half the words in that thread about like the technicalities you guys are talking about. So I don't know how you do it, man.
Oh, I like to learn. Like to get into the weeds on stuff where I can. But yeah.
Well, I was just going to say one thought around expectations of earnings and beats. There's a lot of people confused because we obviously saw a huge EPS beat and revenue beat from Coinbase. And the stock was down about 3% after hours. And what are we at today?
Down 3%.
Down 3% on a day where Bitcoin's soaring. So it really gets into this idea of expectations and also understanding some of the nuances of EPS. This past quarter, there's an update to the accounting standards that make it so that crypto companies or any company with crypto on their balance sheet can mark to market the gain or losses on their crypto book. Whereas before, it's just more so as an intangible asset where you only mark to if there's an impairment, so decrease to the book value. So there's basically this $650 million non-cash gain just on the crypto book that added fuel to their EPS. So they had a huge EPS of like $4.84 dollars per share. But if you take out that 650 million odd, net gain on their crypto book, which is great, that is accretive, but it's a non-cash change. It's, if you look at their operating income or their cash flow from operations, it was good, but it was a bit more in line with expectations. So I think that confused a lot of people. Some people were starting to attribute it to, say, Wall Street analysts weren't understanding the accretive revenue of the sequencer of the base chain, which, maybe is slightly true, but it sounds like, Mike, you're listening to the earnings call. And sounds like they're pretty on it in terms of that respect.
I gotta give it to them. I've been listening to these earnings calls for a while. They get it. The first couple questions were about base, which is super interesting. None of the analysts talk. The other thing that went well in the earnings call is they've been expanding their international presence. So they've got a couple of offshore exchanges now. They did 76 billion in volume in the last quarter, which is, I've always thought that's just a slam dunk opportunity for them because most of the trading happens offshore at this point, and you have to do it through shitty venues that you don't really trust for the most part. So if you just have the Coinbase brand that you trust, like that should just hoover up so much market share, and people are going to be super fee insensitive for the most part. They got perps now too. Like that's going to be a massive business for them.
That is a big one. The biggest things and why people are like, why is the stock down? To point out like some of the misses was consensus around monthly transacting users. They missed decently in terms of from reported 8 million to consensus 8.8 million. So that's what Wall Street was looking at to assess how competitive the ETFs are. It still grew quarter over quarter, but didn't, I guess, match the growth people were expecting. And it's leading Wall Street to say maybe the ETFs are actually taking some of the volumes, which and it's less about the institutional side and it's more about the retail side in terms of because that's where Coinbase makes such a high take rate, and there's some truth to it. People are focused on the potential of the ETH and other ETFs. Obviously, I think that's further down the road, but I think the biggest point people missing is just the operational leverage, and yes, around the edges, having an ETF outstanding, is not as good for Coinbase as if there wasn't, right? Like in a vacuum. But the thing is, it's not a zero sum game, and having the ETF, gives price momentum, brings in more users, allows people to explore into other parts of the ecosystem. So just in Bitcoin or something, sure, but it has such a multitude of higher operationally leveraged impact on their business that I think people kind of underestimate. And the other aspect that people point to is just the declining take rate. With the Robinhood and other competitors bringing their overall fees down, people point to Coinbase's high retail percentage. But I think that's something that's perpetually underestimated. They always beat on this, and that surprises people. It will come down over time, obviously, but I did think that international reveal where they first talked about international being 17% of revenues, up from 12%, that was zero not too long ago. So that's a huge growth driver, particularly even when market stalls or they're not expanding volumes, they're gaining market share in both US and international, and the business is humming. Stablecoin supply is growing really strongly. And yeah, it's cool to see some of the costs were higher, but not exorbitant, and they didn't add a single headcount during the quarter. So I think there's a lot to like in the results, and so much of the business just depends on the trading volumes in the broader environment. That they're doing what they need to do. The rest of it, they kind of can't control in terms of broader crypto momentum.
One point, just macro wise, to make on this is one of my favorite lines is liquidity begets liquidity. And it's basically what Ken Griffin and Virtu and Susquehanna all base their models on, is if you become the go-to liquidity provider, and Binance and all these other exchanges are less reliable, it doesn't matter if your fees are cut because your scale is going to get enormous, right? And so if you become the global leader, you're like the global New York Stock Exchange of this new asset class. I think that is kind of an interesting framing of this whole thing, because look where Citadel and Susquehanna and Virtu, I think they're like 60% of trading volume in the overall equity market. And liquidity just keeps pulling there because that's where things are trading. And so you could kind of see that with Coinbase as their competitors and become less reliable.
One other interesting thing I just wanted to share here is somebody looked back at what was the retail revenue in Q1 2021, which is basically arguably the top of the everything bubble, at least, we'll see. But overall, it's really interesting to compare consumer versus institutional in this past quarter, 2024, 56 and 256 versus Q1 2021. So we're back from an institutional perspective at 256 versus 215 back then. But look at how much consumer or retail is dragging at 56 versus back then it's 120. So retail is not really back yet. It's really been institutional.
I actually got flamed on Twitter for saying this a couple months ago. It just does not feel like retail is back in this market. And people say, well, what about meme coins? That is crypto PvP people. It is. I'm telling you, we would see it in our data. It's just retail has not returned to this market.
Content on the transacting user number. Coinbase's peak in 2021 was 11.3 million. They're at 8 today, up from 7 in Q4. I mean, that's a huge way to go before you're back to
huge difference. That roughly lines up. Yeah, I don't know what it's going to take. Maybe historically it's been a sustained breakout from all-time highs. I don't know.
We're in a very different world in terms of inflation versus back then. The hurdle rate for extra income to throw at meme coins and even speculating on Bitcoin, rationally, it's okay if this is occurring, you'd want to buy these things or at least Bitcoin. But day-to-day expenses are much more expensive than they were in 2021, shockingly so. Yeah. So do we even think they're going to come back, or do we need to just know that mostly this is going to be driven by institutional flow?
Fed needs to do airdrops. airdrops for the US dollar.
That did do an airdrop.
Well,
That's
they
literally what they did.
They
They
did
did
in
an airdrop.
2021. Yeah, that's
The
why.
irony
That's
is
why
they-
we're
going to rebrand this. QE is now an airdrop.
Airdrop. That's actually, you know what? They actually tried to do an airdrop and they realized they didn't have the infrastructure and they looked to crypto for a period of time to see if that was the solution. And people were like, wait, is everyone going to get a wallet so the Fed can do its USD airdrop? That was a funny moment in time, man.
I forgot about that
Man,
aspect.
that feels like forever ago.
And China did it, right? China actually did it, I think.
Yeah.
And then in the
I
end,
don't
they had
know.
to delay it so that Trump could sign the paychecks personally.
Oh
All
my
of
God.
that.
He just gets branding though. That is such
Oh,
a,
Oh, yeah.
everyone was like, oh, but it's smart. I mean, you look to see whose name is on your paycheck. I know we got to wind down here in a second. Do you guys want to do this meme of the week segment? I want to make this a thing because I can't remember. One of you guys dropped this in here. So whoever it was, claim credit. But
Oh, yeah, is this the Apollo one?
This is the Apollo one.
Yeah.
This cracked me up. All right, so the backstory. So this is high yield Harry, and this is a uncut gems thing. Apollo, after realizing they can take life insurance policy out on strangers, is Adam Sandler saying, "Let's bet on this." The context is that Apollo is accused in a lawsuit of illegal human life wagering scheme, and I'm reading this from Bloomberg, but Apollo Global Management bet on the longevity of senior citizens by acquiring illegal life insurance policies and funneling payouts through shell entities, according to a new lawsuit. Private equity giant allegedly set up a web of sham trusts using a secretive affiliate called Financial Credit Investment to hold a portfolio of stranger-originated life insurance policies worth roughly $20 million. By taking out life insurance on a stranger is anathema to hundreds of years of public policy and a violation of the Delaware Constitution. So, yeah, it's not looking so good for Apollo. And this reminded me of is, there's this sentiment, especially in crypto, that we're never going to attract the TradFi folks if we have these like speculative things, and it's like Apollo's like, hey, hold my beer. I'm going to bet on when old people are dying. And the irony is that I truly believe that most people in TradFi would rather bet on when old people die than meme coins because at least there's a cash flow they can model. And I truly, I truly believe that.
Can I go on a generational rant here?
Go nuts.
There's this part of the sovereign individual. I posted this week on my Twitter, but this guy recaps the end of the sovereign individual, and he goes, "Why are the cognitive elite morally illiterate?" And if you get into these, like, who actually pitched this? Is what guy at a big institution pitches this and thinks that it's a good idea? Like, this is how run amok we are with centralized, private equity firms and all this crap. Is like,
dude, I would love to be a fly on the wall for this pitch. So fellas, I've got an idea.
It's the cash flow.
And it could rub you the wrong way when I first pitch it, but just hear me out.
10% free cash flow yield on
Don't judge a book by its cover.
Come on, these guys are clowns, man. And the heroes of this generation are the villains of the next. I mean, it's so clear that like everyone in our generation gets it, but there's still people in boardrooms being like, that seems like a good idea. Let's do it. It's great for shareholder value.
My meme of the week is the UNC fraternity that this picture of them holding the flag and then raising a GoFundMe for a rager, quote unquote rager. If you go through that, it's just hysterical. Some of the comments and it's a lesson in marketing. Really, they told a great story and people rallied. Bill Ackman donated $10K, and then you got this crypto meme coin white boy summer kind of tailing off the momentum and this frat boy movement, which is it's just hilarious with everything going on college campuses. So that's my pretty funny meme of the week.
I think there's a macro, like, this stuff seems just like a meme, but there's a cultural component here that's just like largely way bigger than we think. This will be like a picture they show 30 years from now, I bet, when it's like there's this tectonic shifts happening, right? And you can kind of feel it happening. And Ivy League schools might not be what we think Ivy League schools are in 5 years to 10 years. If you go to the Southern schools, a lot of the protests are not happening there. And I think there's this giant diaspora from like this cognitive elite type attitude to like a more cohesive, balanced framework of what education is. So I don't know. I think that's kind of fascinating.
I would give two different ways to interpret this, which is the trend, which honestly I hate, but it's like fighting a current at this point. It's just populism. And populism and nationalism just walk hand in hand. And so there's an element of that that's always going to, and it's, you can see it happening all over the world. The other thing though is that there's this frustrating trend of like whataboutism in the US. And there's this pretty illogical line of thought, I think, which is, well, yeah, the US does some pretty not great stuff. So are we any better than any of these other people? And maybe this country sucks. And I'm just not down with that. And honestly, I haven't been down with that for a little while. And I'm glad to see.
But 2 years ago, you'd get canceled if you said that. And now you can feel the vibe changing where it's like, people are coming up with like this stuff happens throughout history, and the people are studying the history again of like what happened. And it's becoming less, you can be patriotic and not a white supremacist.
You know what actually was something that I registered a couple years ago was someone mentioned to me, there was in my parents used to live in this complex place around Boston, and someone had American flag just hanging out of their house, which is pretty. And someone was like, "Oh, look at those Trumpers." I was like, "What?"
Yeah.
I was like, "What?
How come I can be liberal and hang a flag?" That's the weirdest thing to me.
It's very bizarre.
There's no nuance anymore. There's a Canadian politician the other day who posted there's an initiative that there'd be an option in high school that you could spend more percentage of your time learning trades versus academics. And this was a liberal politician, and she tweeted, "Oh yeah, that's a great idea. Let's let them all not learn how to read or learn about history and let them vote conservative." And it's like, wait a second. Nowhere in here was there a discussion about political inclinations. You can be blue collar and also be liberal. You can it doesn't have to be this way, and we don't have to draw these lines in such a harsh dichotomy. And it drives me crazy because I'm all over the place politically, like spectrum wise. I don't even know how to define myself. Like it totally depends on the topic. So if somebody
goddamn maverick, Felix.
But it's like, why do we have to label these things from the onset and just lose all nuance? It drives me crazy.
It goes to the Chris Rock stand-up. This is what I love comedians, where he's like, "In some things I'm liberal, in some things I'm conservative. When it comes to crime, I'm conservative. When it comes to prostitution, I am liberal."
All right, fellas. Well, this feels like a pretty good place to end it. This was a fun one on Tyler's pro-prostitution.
Actually. Should leave it like that.
All right, Tyler. On that note, Tyler loves the prostitutes, and guys, this has been a ton of fun. And no, just kidding. We got this. All right, see you guys.
Have a good weekend.
Bye-bye.
All right, guys.
See ya.